United Utilities fell 1.5% on Friday as Andy Burnham's allies published a blueprint to seize control of England's water companies using the Paris model of public reacquisition. The surface read is straightforward. A likely incoming prime minister has targeted your asset class, so you sell. But that surface read skips the mechanism Burnham's own team described, and the mechanism matters more than the headline. The blueprint, published in the iPaper on 24 June, was triggered by Burnham's landslide Makerfield by-election win and Keir Starmer's resignation, both of which crystallized this week into near certainty of a Burnham premiership before September's parliamentary return. Starmer resigned as Prime Minister on 22 June after mounting internal pressure, local election losses, and repeated policy reversals. Burnham was sworn in as MP for Makerfield the same day, and a new poll published 26 June showed Labour would leapfrog reform if he led, a margin that hardened what had been speculation into active transition planning. The direct cause of UU's fall is not ambiguity about Burnham's intentions. His allies explicitly named water nationalisation as a priority and attacked dividend payments to shareholders as profiteering. That language sent a clear signal about the direction of travel, and the market reacted to the word, not the mechanics. The mechanics are what the drop has not yet priced. Burnham's allies did not describe a compulsory acquisition at below market value. They described the Paris model, the structure France used to return Paris's water to public ownership, which is a negotiated equity purchase at a price acceptable to existing shareholders. That is not the same as expropriation. In the Paris case, the city government bought out private concession holders at a price that reflected the regulated asset base of the network, not a distressed or politically discounted figure. If Burnham's team applies the same logic, the acquisition price for UU would anchor to the regulated asset base, which is a publicly disclosed, audited figure that gives shareholders a reference point the government cannot simply ignore without triggering legal challenge. This is the buried assumption the consensus has not confronted, that nationalisation means equity value going to near zero. It may mean the opposite, a guaranteed exit at a regulated asset-based price, which would function as a floor under the share price, not a ceiling. The iPaper's Reeves continuity article published the same day introduces the competing read directly. Rachel Reeves is reportedly helping with the transition precisely to reassure markets and provide fiscal stability, with some Burnham allies explicitly arguing she should remain as Chancellor to protect gilt market confidence. Two named source positions are pulling in opposite directions. The nationalisation blueprint signals forced acquisition on political terms, and the market continuity signal says Burnham's own team knows it cannot afford a trust-style gilt sell-off. The tension between those two positions is unresolved, and that unresolvedness is what makes UU's current price neither obviously right nor obviously wrong. The critical constraint on any nationalisation plan is the government's cost of borrowing, and that cost just moved sharply against Burnham before he has even taken office. UK 30-year gilt yields hit 5.73%, the highest level since May 1998, in the day surrounding Starmer's resignation. The gilt sell-off is partly political. Analysts pointed directly to Westminster uncertainty as one of the two forces driving the move, alongside US inflation repricing. Sterling fell to around 1.3500 against the dollar, the second weakest G10 performance, as the combination of hawkish Fed signals and UK political risk squeezed the pound from both sides simultaneously. The arithmetic for water nationalisation runs through those yields. If the UK government needs to issue debt to finance a regulated asset-based acquisition of UU and its peers, it does so at 5.73% on the long end, a materially higher cost than the 4.5% at which Severn Trent's own regulated return is currently calculated. That spread means the government would pay more to borrow the money than the regulated return the asset is permitted to earn. At current gilt levels, nationalisation, as Burnham's team has described it, is economically self-defeating. The government would take on assets whose regulated income stream yields less than the cost of the debt used to buy them. That constraint does not disappear because the politics are popular. It means that if Burnham proceeds, he either has to restructure the allowed return on water infrastructure upward, which raises bills, the opposite of what he promised, or find a different financing structure that avoids gilt issuance at scale. Neither path is as clean as the blueprint implies.
The holder of UU faces a genuinely unresolved question, not a clear-cut exit signal. If Burnham's nationalisation proceeds on Paris model terms, A regulated asset-based acquisition price likely exceeds the current market price, meaning the holder who exits now crystallizes a loss relative to the acquisition price they would have received. But if the gilt cost constraint forces Burnham to delay, dilute, or abandon the program, UU's dividend yield and regulated income stream reassert themselves as the dominant valuation driver, and the current sell-off looks like a liquidity event, not a structural repricing. The counter-evidence to the floor thesis is the political language. Burnham explicitly attacked dividend payments, which are the mechanism by which regulated equity holders extract returns. If a future government caps or redirects those dividends without full acquisition, the floor breaks, and the holder is left with an asset whose income is politically constrained, but whose capital is still exposed. That scenario does not yet appear in the pool with concrete legislative detail, but it is the real risk, not the acquisition price itself. The watchlist candidates question is simpler, but equally unresolved. Does a regulated asset acquisition at a negotiated price create a tactical entry on the way down? Or does political dividend risk make this unownable until the leadership contest produces a concrete legislative commitment? The variable that resolves both questions is the King's Speech. If Burnham's government includes a water industry public ownership bill with a defined acquisition mechanism, specifically whether it anchors compensation to the regulated asset base, the uncertainty collapses into a pricing event. If the King's Speech omits water nationalization or defers it to a consultation, the political risk premium fades and UU's income characteristics reassert. That is the single variable that matters, not whether Burnham becomes PM, which this week's polling makes near certain, but whether the King's Speech turns the blueprint into a bill with a compensation formula. Until that is known, the rational posture is to hold existing positions and observe rather than chase the current move in either direction. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.